Stop what you're doing right now. Put the phone down, mute the TV, and look at me for 1 second, because what I'm about to tell you is not something that's coming. It's not a warning about next year or the year after. It is happening right now, this week, in bank branches across Canada, and almost nobody over the age of 60 has been told a single word about it. The rules around how you move your own money have been tightening quietly for years, with no news coverage, no government announcement, and no letter in your mailbox. And if you try to withdraw or deposit a large amount of your own money the way you did 20 years ago, you can be flagged, delayed, reported to a federal agency, or in some cases have your own account frozen, even though you have done absolutely nothing illegal. I'm David Harper. Today, I'm walking you through exactly what has changed, who it catches, why retirees are getting hit the hardest, and the 5 specific moves you can make this week to make sure your own money goes where you want it to go without any of that happening to you. This is one of those videos I wish I had made sooner. Before we get into the details, subscribe to this channel and tap the bell right now. This kind of information does not make headlines. It doesn't get explained at your bank branch unless you specifically ask. The only way it reaches you is through a channel like this one, and the only way you'll catch the next update is if you're subscribed. Hit subscribe, tap the bell, and let's get into exactly what has changed. To understand why this is hitting retirees so hard right now, you have to start with one number that has never once been changed. The $10,000 cash reporting threshold was written into Canadian law decades ago, when the country's anti-money laundering rules were first built. Think about what $10,000 actually represented back then. It was a serious portion of a house purchase. It was more than most Canadians earned in a full year of work. $10,000 in cash was a genuinely unusual, genuinely suspicious amount of money for an ordinary person to be moving around. That threshold has never been adjusted for inflation, not once, not ever. But the world around it has changed completely. Today, $10,000 is a used car. It's a kitchen renovation. It's a dental implant or a hearing aid. It's a down payment gift for a grandchild. It's a lump sum from a late spouse's pension. It's a home insurance payout after a broken furnace and a flooded basement. All of these now routinely cross that line for a perfectly ordinary retiree living a perfectly ordinary life. When that rule was written, $10,000 in cash was the signature of organized crime. Today, that same frozen number catches your neighbor buying a car with her savings. That is the starting point. Now let me walk you through the 4 specific ways the system around that number has tightened without anyone telling you. The first change is the one that surprises retirees the most because it feels the most personal. In response to a very real and very serious problem, fraud targeting seniors, Canada's banks have sharpened their internal systems for flagging what they call unusual financial activity on senior accounts. On paper, this is a good idea. Seniors in this country lose hundreds of millions of dollars every single year to romance scams, grandparent scams, and fake investment schemes. And the banks are trying to catch those crimes before the money is gone. But here is how it plays out at the counter when you are simply a competent person trying to access your own savings. Your bank's software is watching the pattern of every transaction on your account. If you have spent 10 years withdrawing $200 or $300 at a time, and one morning you walk in and ask for $8,000 or $10,000 in cash, the software does not know you are buying a used car. It does not know anything about your life. It sees a break in the pattern, and it flags it for a human review. That review means questions you were not expecting. Why do you need this amount today? Did someone ask you to withdraw this? Have you met anyone new recently online? Those questions are not meant as an insult. The teller is trained to ask them because sometimes they catch a genuine scam in progress and save a person's entire life savings. But for a sharp, fully capable retiree who simply wants their own money, it can feel like an interrogation, and the bank can place a temporary hold on the transaction while it satisfies itself that you are not being exploited. Let me give you a real-world picture of this, so it isn't abstract. Picture a woman, call her Margaret, a retired teacher, 71 years old, who walks into her branch of 20 years to withdraw $9,500 for a used car she found through a private seller she knows personally. She is not being scammed. She knows exactly what she is doing, but she has not once withdrawn more than $500 at that branch in several years. Her account gets flagged automatically. The teller asks questions. A supervisor gets involved. The transaction is held for 2 days while the bank's fraud team reviews the file and tries to reach her son, whom she never listed anywhere on her account. She misses the car. That is not an invented horror story. That is the kind of thing happening at bank counters across this country right now, to people who have done absolutely nothing wrong. There is no single law in Canada that forces your bank to freeze a senior's account for a fixed number of days. What exists is a system that increasingly allows and actively encourages banks to pause and review transactions on senior accounts that look unusual, and the incentive only runs in one direction. A bank that pauses your withdrawal and turns out to be wrong pays no meaningful penalty. A bank that releases money to an actual fraudster faces an angry customer and national headlines. So when in doubt, the institution pauses first and asks questions second. That is the change. It's quieter than what you may have seen in American videos, but it is real, it is happening, and it is affecting Canadian retirees right now. The second change is the most dangerous one on this list because it carries actual criminal consequences, and it traps a kind of behavior that many retirees genuinely think of as simply being sensible. Here is the rule. Anytime you deposit $10,000 or more in cash at a Canadian bank, they are required to file a large cash transaction report to FindTrack, Canada's federal financial intelligence agency. That report is automatic, it's routine, and on its own, it means nothing. But if you deliberately split your money into smaller amounts specifically to avoid triggering that report, that is called structuring. And in Canada, it is now a specific written criminal offense carrying the possibility of prison time and serious fines. And here is the part that catches people off guard. The money does not have to come from anything illegal. It can be 100% clean, the proceeds of a home sale, an inheritance, an insurance settlement, your own pension lump sum, money you saved in a shoebox for 30 years. It does not matter where it came from. If you intentionally broke it into smaller pieces to stay under the $10,000 line, you have potentially committed a federal offense. For years, the obvious version of this was someone walking in day after day depositing $9,500. Everyone understood that pattern. But the detection software banks use today is far more sophisticated than that. It is not just watching for deposits right under $10,000 anymore. It is looking at the overall shape of your activity. Several deposits of $7,000 or $8,000 spaced a few days apart in a pattern that could suggest you are managing around the threshold. That does not mean you will be charged with anything, but it can mean you get flagged. And a flag can trigger the second type of report, which is far more serious than the routine cash report, and which I am going to explain next. The cruel irony of this change is that the people most likely to get tangled up in it are not the criminals. The criminals know this rule inside out. They have accountants and lawyers who keep them well clear of it. The person most likely to accidentally structure a deposit is an honest retiree who heard a tip from a neighbor at a dinner party who said something like, "Break it up so it doesn't attract attention," and genuinely thought they were being smart. That tip, that single piece of well-intentioned advice, is the thing that creates the problem. Please never break a deposit into pieces to stay under the line. Do not do it for a car purchase. Do not do it for a renovation. Do not do it for a gift to a grandchild. If the money is yours and it is clean, the cleanest thing you can do is move it all at once. The third change is the one that should make you the most careful because it operates entirely in the dark and you have no way of knowing when it happens. Alongside the routine large cash transaction report, there is a second type of filing called a suspicious transaction report, and this one has no minimum dollar amount at all. There is no floor. A bank can file one based on a transaction of any size if the behavior around that transaction looks like someone is trying to avoid detection. And here's the part that genuinely matters. You will never be told one has been filed. It is actually against the law for a bank employee to warn you that a suspicious report has gone in. They are legally required to file it quietly. So you could be flagged today, sitting right now watching this video, and have absolutely no idea. And that report sits in a federal database, cross-referenced against your future transactions for years. The large cash report is routine and harmless. The suspicious transaction report is targeted and serious. And the difference between triggering the harmless one and the dangerous one usually comes down to a single decision: whether you moved your money cleanly and openly, or whether you tried to be clever about it by splitting it up. One clean move triggers a report you will never feel. One attempt to be smart about staying under the line can trigger something far more serious. And here is something worth sitting with. If a suspicious transaction report is filed on your account and you later apply for a mortgage, try to open a new account at a different bank, or make another large transaction months or even years from now, that report in the FinTrack database can surface again. You do not get notified that it exists. You simply find that things are slower, more complicated, and harder to explain without ever being told why. The fourth change is that this reporting system no longer begins and ends with physical cash handed across a bank counter. Two developments in recent years have stretched the net significantly. First, international electronic transfers. When $10,000 or more moves into or out of Canada electronically, that gets reported, not just to FinTrack but also to the Canada Revenue Agency. So a large wire transfer sent to family overseas or a significant amount coming in from abroad now lands in exactly the same reporting pipeline as a physical cash deposit. Second, cryptocurrency. Canada has formally brought large virtual currency transactions into the FinTrack system. A crypto transaction of $10,000 or more now triggers its own report in the same way a suitcase of cash used to. The clean separation that once existed between traditional banking and digital currency is gone. Now I want to be very clear about something because there is a lot of American misinformation circulating online right now. And I do not want you making a bad decision based on someone else's country's rules. You may have seen videos claiming that every small e-transfer or every payment over $600 is about to be reported to the government. That is a United States rule. It does not apply in Canada. Your Interac e-transfer to your grandchild, your monthly payment to a family member, your small online purchases, none of those are being reported to the CRA at $600. Do not let an American headline frighten you into doing something unusual with small everyday transfers. In Canada, the number that triggers a report is still $10,000. Everything I have described today lives above that line. So that is what has changed. Now here is what to actually do about it, because the point of this video is not to frighten you. It is to make sure your money goes where you want it to go, when you need it to go there, without any delays or flags or frozen accounts. There are 5 specific moves, and every single one of them is free to put in place. This is the single most powerful thing you can do, and it costs you nothing. Before any large withdrawal, deposit, or transfer, call your branch ahead of time, or walk in and speak to the manager and tell them what the money is for. Say it simply and directly. I am planning to withdraw $12,000 next Thursday to purchase a used vehicle from a private seller. Here is the seller's name. That is all you need to say. When the transaction arrives in their system, the explanation is already attached to your file and sitting in the notes. The routine cash report over $10,000 still gets filed automatically as it always has, but your money actually moves when you need it to, instead of sitting under a hold while someone tries to figure out what you were doing and why. This one phone call ahead of time is the difference between Margaret's story and a smooth 10-minute branch visit. If you need to move $12,000, move it as one single $12,000 transaction. Do not split it into 2 amounts of $6,000 to stay under the threshold. One clean movement triggers a routine report that you will never feel. 2 carefully sized movements designed to stay under the line is the exact pattern the software is built to detect and flag. This is the most important thing I will say in this entire video. That single instinct to break it up is the one that creates the problem. This is a quiet and powerful option that most Canadians have never once heard of. You can give your bank the name of a trusted person, an adult child, a close friend, a neighbor, someone they are allowed to call if they have a concern about a transaction or about your well-being. And here is the critical detail. That person cannot touch your money. They cannot make any decisions for you or about your account. They are simply a phone call the bank is permitted to make to confirm that you are fine and that the transaction is yours. Having a trusted contact on file can be the difference between your money releasing the same day and sitting frozen for several days while the bank tries to figure out what to do. To set this up, simply walk into your branch or call the general number and say, "I would like to add a trusted contact person to my account." They will ask for the name and a phone number. The whole thing takes about 5 minutes and it stays on your file until you choose to change it. Most people who do this say they wish they had done it years earlier. For any transaction over a few $1,000s, take 2 minutes and write down the date, the amount, where the money came from, and what it was for. A small notebook is enough. The bill of sale for the car, the gift note from the estate, the insurance settlement letter, drop them in a folder and put the folder somewhere you can find it. You will almost certainly never need any of it. But if anyone ever questions a deposit from 3 years from now, that folder is your complete, immediate answer. Moving $50,000 in physical cash sets off every alarm in the building and is genuinely dangerous to carry. A certified bank draft or a bank-to-bank wire transfer moves through a cleaner channel with far fewer flags, and most car dealers, lawyers, and contractors actually prefer receiving it that way. For amounts well over $10,000, ask your bank about the cleanest electronic option before you default to taking the cash out in person. Here is your checklist for this week. Call your branch before any large withdrawal or deposit and tell them what it is for. Never split a large amount into smaller pieces to stay under $10,000. Ask your bank today about naming a trusted contact person on your account. Start a simple folder for any transaction over a few $1,000s. Keep the bill of sale, the estate letter, the insurance document. And for very large amounts, ask about a bank draft or wire transfer instead of physical cash. 5 moves, all of them free, all of them available to you this week. Before I close, let me answer the 3 questions I know are already sitting in your head. First, does this mean I should avoid large cash transactions entirely? No. Moving your own money in cash is completely legal, and there is nothing wrong with it. The only thing that matters is that you move it cleanly, in one transaction, with an explanation in place. Second, if my bank already filed a report on me without my knowledge, is there anything I can do? Not directly, because you have no right to see the suspicious transaction report or demand its removal. What you can do is make sure every future transaction is clean, explained, and documented, so that if anyone ever reviews that file, the overall picture is clearly innocent. Third, I've already split up deposits in the past because a friend told me to. Should I be worried? If it was a one-time or occasional event and the money was genuinely clean, the realistic answer is probably not. But the right move going forward is to stop doing it entirely, and if you have any real concerns about a specific past transaction, a brief conversation with a lawyer who handles financial matters is worth the hour. A quick note as always, this is general information to help you understand how these rules work, not legal or financial advice specific to your situation. If you have a complex or unusual circumstance, it is always worth a direct conversation with your bank manager or a financial advisor. The $10,000 rule is not getting simpler, it is not getting more retirement friendly, and it is absolutely not being adjusted for inflation. It will keep expanding and keep catching people who were simply not told it had changed. The retiree who gets caught off guard is the one who never gave the bank a heads up, never named a trusted contact, never kept records, and in a moment of panic broke a deposit into smaller pieces at exactly the worst time. The retiree who takes these 5 steps moves their own money freely, the way they always have, and the way they are fully entitled to. If this helped you, share it with one person you know who is over 60 and moving real money through their account right now. They are almost certainly doing at least one of these things the hard way without knowing it. And subscribe, because this is all I do here. I take the rules the system is quietly changing around you, and I make sure you actually know about them before they cost you. I'm David Harper. Don't let a rule you didn't know about get in the way of your own money. I'll see you in the next one.